There we go. All right. Well, I'm going to do a quick screen share here and we'll get going. All right. So don't worry about that QR code. Unfortunately, I'm not hooking up drink tickets tonight on the webinar. Sometimes I do this at a local brewery. So this is my webinar event. But anyway, just to kind of get us started here. Make sure we're there. We go. So a little bit about me. My name is Nick Paynes. I'm managing broker for Remax Alliance. I'm also team lead for the Meta Homes team here in Westminster. We're one of the top producing teams in the state of Colorado, and we specialize in, or I should say, me personally at least, I specialize in listing and in investment real estate. So I sell homes and do investment real estate. And the rest of my team, they also sell homes, but they work more with buyers and things like that. So anyway, we kind of have a full gamut of who we work with. I also am a certified real estate coach for Workman Success Systems based out of Utah. I coach real estate agents across the nation, and I am a national speaker on real estate investing and other topics for business, building business. So anyway, that's a little bit about me and kind of some, I call these prerequisites. They're not really prerequisites. They're just other classes that I offer. I do kind of run these in order though. And so like once you do number one, then number two makes sense. And then number three makes even more sense. So obviously you can watch these individual themselves, but or of each other, but we have other classes that kind of lead into this one. So this is the most advanced class. I do a one-on-one kind of beginner's guide. We talk about house hacking and how to kind of acquire your first rental. And then I do a secondary class that teaches you how to build that rental portfolio and kind of double, go from one rental to two, two to four, four to eight, et cetera. And how we work on that acquisition, that leverage. And then we talk a little bit about exchange and exit strategies of your portfolio, which we'll also talk about today. And then we talk about how to scale using basically using the money that you earn from the properties that you've already purchased. Okay, so just more of a leverage play. So um, the this particular class, we're going to talk about kind of four big pieces of real estate acquisition. So we're going to talk about once the properties are acquired, what are we doing to help offset tax liability? And then we'll talk about kind of the higher levels of how we offset tax liability kind of at the end. But we're going to talk about three main strategies with that. It's overall depreciation, which some of you might be familiar with, how you depreciate a property. We're going to talk about the next level of depreciation, which is what we call cost segregation and bonus depreciation. And then we'll talk about what it means to be a real estate professional and how that affects, again, at another level, your real estate, or I should say your overall income taxes and how we can use real estate to offset income taxes. Um, so to kind of get started, let's talk about depreciation. First of all, kind of the basics of depreciation is that residential real estate is depreciated over 27 and a half years. We call that straight line depreciation. So you can see down here straight line depreciation. Most people use straight line depreciation when they depreciate your assets. So it's pretty simple. If you bought an investment property for $275,000, your straight line depreciation would be 10 grand a year. Okay. Commercial depreciation or commercial real estate is depreciated over 39 years, just so you know. And how we determine what can be depreciated is pretty simple. It's the building itself and all of its components. The land cannot be depreciated. So if you made a purchase of a property that was 275,000, that was your total single family purchase, you're likely going to depreciate less than that because there's going to be a land value assigned to that. That's usually going to come through your appraisal or through an assessed value that your CPA is going to use. They're going to subtract that from the 275 acquisition price. That number is going to be your cost basis, and then that cost basis is going to get divided by 27 and a half, and that's how much you can write off per year. Okay. So when you put depreciation kind of into practice, what it looks like is if you use that straight line depreciation of an asset for, let's say, the first 5 years at $10,000 per year, you're going to be able to offset $10,000 per year of rental income. Okay. So because rental income is taxed as ordinary income, or I should say rental income is taxed as ordinary income. So you'd be taxed on the $10,000 the same rate as your ordinary income. So let's say you were, in a 22% tax bracket, you're going to owe $2,200 on the $10,000 worth of rental income that you have. Okay. So in this case, if you had an effective tax rate of 22%, you would have deferred $13,750 in taxes over that 5-year period. Okay. So, because that would be your tax liability on $50,000 worth of total residential rental income that would be coming in. Okay. So that's kind of what things look like in practice from a depreciation standpoint. Now, when we talk about exiting or selling a property, we have to take into consideration what we call depreciation recapture. Okay, so in the last example, we saved $13,750 worth of ordinary income. So when you have depreciation, it's a tax deferment and not a tax exemption. So when you sell the asset, the IRS is going to recapture that depreciation. But the nice thing is that recaptured depreciation is taxed as ordinary income, but it's capped at 25% currently. Okay. So if you were in a much higher tax bracket, let's say you were in a 37% tax bracket, okay, you would want to take heavy advantage of depreciation and cost segregation and things like that to offset tax liability now. And then maybe later in life, when you sell the property and your income's not as high, okay, then you would only have to pay that back at 25%. Okay. So in this case, you would have saved $13,750, but when you sell the property back, you're going to pay back a maximum of $12,500. Okay, so not only do we get to defer $12,500 in taxes, but in this case, we actually got to exempt ourselves from another $1,250. Okay, so that's kind of the overall basis of depreciation recapture. Sometimes we get into, and we talk a lot in our second class, our intermediate class, about 1031 exchanges. There is an opportunity to defer this tax even further through a 1031 exchange, which is when we sell the property, we actually take this tax deferment and we roll it into the next property, which allows us to get to an opportunity, basically gets us to an opportunity where we push everything and we kick that can down the road as long as we can, keeping that tax deferment and pushing it as far as we can. Because the nice thing about a tax deferment is when you pay it back to the IRS, there's no interest on it. So if I defer $100,000 worth of taxes for the next 30 years, well, 30 years from now, I'm going to owe the IRS $100,000. I'm not going to owe 100 plus interest or 100 plus penalties. Tax deferment is basically me borrowing the government's money at interest, at an interest rate of 0, and paying it back when I'm done with it. Okay, so how does this benefit us? So it kind of, we look at it, and again, this is what we just talked about. It may look like we're kind of robbing Peter to pay Paul, but if you really understand the future value of money concept, you know that even if we break even on tax savings versus the tax that we owe, the money now that we're saving is worth more than the money later. So if I can save $10,000 now and pay that $10,000 back 5 or 10 or 15 years from now, that's very valuable. Okay, so we compound this over more years, and then again, like we talked about, we can utilize the 1031 exchange to push that tax liability down the road, and we get some really serious tax benefits. Okay, all right. So any questions to start on depreciation? It's a pretty basic concept. Anybody that owns real estate that files their taxes with a CPA is likely doing some sort of depreciation on their property. Any questions on that section before we get into cost segregation? All right. Cost segregation is the second piece. Okay, cost segregation is, it's a study that allows an investor to accelerate the depreciation of a property. Okay, so it's a really powerful tool because what we can do is we can really offset capital gain tax, and it's even more powerful when we talk about becoming a real estate professional, which we'll talk about at the end of our discussion. Okay, so the way that cost segregation works is you hire a company, and these companies generally are firms with engineering, construction, tax law, or accounting expertise, and they kind of perform like an appraisal evaluation of your property. Okay, but it's a much more in-depth appraisal. It's more comprehensive. So the valuation that they're going to do is going to break out each individual component of the property, and they're going to move each of the assets inside the property into 5-year, 7-year, 15-year, and the original 27.5-year buckets. Okay. And then these items, as they're dropped into these buckets, they're given a particular value, and then they're depreciated individually according to the bucket that they were placed in. Okay. So let me give you an example of this before we move on. So, for example, if you buy property, it's understandable that maybe the walls and the framework and things like that might be depreciated over a 27.5-year period. But like your carpet's not going to last that long. Your appliances are probably not going to last that long. Your furnace, your water heater, that type of stuff is not going to last 27.5 years. So depreciating it over that period of time, we lose a significant portion of that depreciation because we end up replacing the item before it's fully depreciated. Okay, and so what happens is we take those items and we drop them into these buckets. And so let's say we drop your furnace into a 7-year bucket, and now we can take a $4,000 furnace, and rather than depreciate it over 27.5 years, we can quadruple that by depreciating it in 7 years and taking, a $600 or $700 per year depreciation versus, a $200 per year or $150 per year. Okay. So we're going to depreciate all the items individually, and we're going to drop them into the buckets, and we're going to depreciate them, based on that bucket. Okay, so let's take a look at an example. This is a real example of what a portion of a cost segregation analysis report looks like. Okay, so first of all, the property is, we've got a total value of the property here. Okay, so in this case, it was just under $750,000, and the property is initially broken into land and building. Again, we can't depreciate land, so we have a total depreciable cost basis of $594,000. Okay, so when you start the process, they're going to give you an evaluation of your depreciation with and without cost segregation. So on this particular property, you could see that down here at the bottom on this graph here, and right here, it says without cost segregation. Okay, this property, you could have done $11,701 worth of depreciation in the year 2022, and this is partially because of when this property was actually placed into service. So if you wanted the full year cost segregation value, you would just take 594 and divide it by 27.5, and that number is really close to around 22,000. So a full year of depreciation of this property would have been about 22,000. However, with cost segregation, this particular property was able to take a depreciation of 194,000 and change in the first year. Okay, and so what happens is we take this 194,000, instead of taking 22,000 in the first year as depreciation, we take 194,000 and we front load all of that depreciation. Okay, so here's what it looks like. The graph that we have, this graph depicts this property of 594,000. And then it shows the buckets on the right and how much of each of those buckets, or how much of the property or value is allocated to each of the buckets. So we have 70% of the property still in that 27.5-year bucket, but we were able to move up $133,000 of the 5-year cycle that are in the 5-year cycle and put it into this bucket, and 15-year cycle and put it into this bucket. So if you divide this number by 5, this $133,000 number by 5, okay, you get what you could take each year. So in this particular case, you're looking at, I don't know, what is that, 25, 26 or $27,000 a year just in the 5-year bucket. Then you can take this 52,000 and divide it by 15. I think I actually have this on one of my slides here. Let me just go through this. Yeah, here we go. So I'll pop back to the slide before it, but the 5-year bucket has the 133, which is $26,792 per year for the first 5 years. Then you get to add what's in your 15-year bucket. So there's $3,500 for the first 15 years. And then you get to add what's left of the 27.5-year bucket, which is $14,807. Okay, so instead of writing off the 21,602 that I guesstimated earlier with straight line depreciation, we get to write off $45,125 per year for the first 5 years. That's all of those buckets added together. After that, it drops slightly. You get 18,000 instead of 21,000 versus straight line. And in the last 12 and a half years, okay, from year 15 to 27 and a half, your depreciation goes down to 14,807. So the idea is we front load a bunch of the depreciation, which means in the later part of owning that property, we're not taking as much depreciation, okay? So this is just a sample shot of what a cost segregation report looks like. They literally break out there's pages and pages and pages of this. And what it does is it breaks out literally every individual item in the house. So you can see here, baseboards are evaluated at $6,422 throughout the house, and they're dropped into the 5-year bucket. You can see that a refrigerator, not just the refrigerator itself, but all the outlet boxes, the wire, the copper wire, the wall plates, they break these things down and they drop them into the buckets. So I chose this screenshot because then you can also see something that might be dropped into a 15-year cycle. So this property had a big stone retaining wall, so they put that in the 15-year. They put the fence in the 15-year. Okay, they put concrete paving in the 15-year. Right? So this is what a cost seg report looks like. They're going to break down literally every single item in the house and put it into a 5-year bucket, a 15-year bucket, etc. Okay. All right. So again, this is what the result kind of looks like. And so what happens is we end up with these bigger losses in the first year. And sometimes you think, well, what if I don't have the income to offset the loss and I don't need to take that big of a loss? That's perfectly fine. The nice thing about real estate losses and real estate depreciation is that it carries over indefinitely. So if you took a $50,000 loss on a property this year and only made $30,000 in income on a property, you would only need to offset that $30,000, mean you still have a $20,000 loss. Well, that'll just kick over to the next year and you can use it the next year. So you don't have to worry about like, oh, am I going to lose it, or why would I front load it if I'm not going to use it? And we're going to talk about why here in a second. Okay. So any questions on what a cost segregation analysis is or how it works? Feel free to drop it in the chat or unmute. All right. So let's move into the third piece, which is what we call bonus depreciation. Okay. So bonus depreciation came from the Tax Cuts and Jobs Act of 2017. And what it did was it enacted bonus depreciation, which allows an investor to cost segregate an investment and then take everything that falls within the 5-year bucket and depreciate 100% of it in the first year. Okay. That act allowed that to be valid or in place through 2022, and then that particular portion of the tax bill is sunsetting, meaning that in 2023 that bucket goes down to 80%. This year in 2024 it goes to 60%. Next year it's 40%. The year after that it's 20%. And then it'll be at 0%. And then at that point, maybe we have the tax code rewritten. It's probably going to depend on who gets elected, this upcoming year to see if we have something that gets extended here. But in this particular case, as of right now, 60% of everything that falls in that 5-year bucket can be depreciated right up front. Okay, so what ends up happening is bonus depreciation allows you to take significant losses in your first few years of ownership of the property. So you're deferring any gains that you would have on that property. Okay. And the losses on paper carry over, like we talked about, and they can be used at a later time when they're gains. So for example, if you were to sell a property, okay, and make 100 grand on it, you could use the depreciation of that asset to offset that. Okay. Now, again, we do have recaptured depreciation. So the idea is, can you use the forward the depreciation you used on this particular property to offset the sale, the capital gain of the sale of that same property? Not really, because you're going to have recaptured depreciation. But what you can do is you can sell an asset, okay, that you've owned, maybe you take a nice gain on it. Maybe you make $100,000. Well, instead of having to pay tax on that $100,000, buy a new asset, buy a new property, cost segregate it and depreciate it, and take a big loss in that same year, and you'll offset the entire capital gain of the property that you just sold. Okay, so in this particular example, if the property that we talked to that we put in place was in service in 2022, a bonus depreciation of over $200,000 could have been taken in year one, and I think it's because it was the 11,000 plus the 188 or 189,000 that was there. So you get about $200,000 in depreciation taken in year one. Okay, if that same property was placed into service in 2023, the bonus depreciation would be the 80%, and so you'd be able to cost segregate and depreciate $160,000 on that property. For 2024, again, it's 60%, so you'd be around 120K. But you still get to report a huge loss in that first year. Let's see, we got a chat question here. Jeffrey, first of all, the foundation of the property is going to be considered part of the building, and so that's going to be in the 27 and a half year bucket. And then Ed, is there a reason you would not do segregation on every property you own? Yes, and so we'll talk about that here in a minute. I'll talk about that in our last section. And if for some reason I forget, remind me. So a little bit of, let's see, do I want to talk about that yet? Yeah. So a little bit of some tax advantage stuff outside of the cost segregation piece. There's some different things that you can exchange into these, and these are some ways that you can have tax advantages even without cost segregation or bonus depreciation. So one of them is opportunity zones. I'm not going to go deep into opportunity zones. We could do an entire class on opportunity zones, but opportunity zones allow an investor to offset all of their capital gain or some of their capital gain if they hold, and if they, like I said, if they hold it long enough, it can be all of their capital gain. So what happens is there's a tax deferral through 2026, and a taxpayer can elect to defer the tax on some or all of the capital gain if during the exchange period, so once they sell a property, okay, they invest in a qualified opportunity fund. And so a qualified opportunity fund, there's different areas of different states that say, hey, come invest here. It's the government's way of building up areas that may not be as desirable anymore. So they create opportunity zones that say, hey, if you invest here, okay, we'll give you a step-up tax basis of 10% or 15% of deferred gains. So what that step-up means is if you had $100,000 in capital gains, they're going to give you the first 10 or 15,000 of that tax-free if you invest in an opportunity zone. Now, if you stay in that opportunity zone for at least 10 years, okay, and the property is equal to the fair market value on the date or sale exchange of what you bought it for, then there's no tax on any of the appreciation. Okay, so if you hold it long enough, you literally get rid of all of your tax. And so that's why some people will buy in opportunity zones, because if they can gain $1 million there, they're not going to owe any taxes in 10 years when it's done. Okay, there's other opportunities. There's a interesting piece of the tax code that basically said up until 2022, gas stations and car washes, they followed the bonus depreciation method, but up until 2022, gas stations and car washes could be depreciated. The entire asset could be depreciated 100% in the first year, allowing for huge losses. And so I don't know, for those of you that might be in different states, but in the state of Colorado, from about 2018 up until even very recently, like there was a huge influx of car washes being built all over the place. There were brand new car washes all over the Denver metro area. This is part of the reason. You can buy a car wash, and here's kind of the crazy thing. You can take $250,000 in cash, buy a car wash for $1 million at $250,000 down and finance the rest, okay? And then you can take $1 million loss on that car wash, offset $1 million worth of gain somewhere else, which would save you probably $300,000 to $400,000 in taxes, and then do it again. And so this is the way people were building like massive amounts of assets, is that they're using tax leverage to offset their income taxes, which we're going to talk about here in a minute, and which would thus allow them to go purchase another piece of property and do it again and create this huge cycle. Okay. All right. So how can we leverage bonus depreciation? So when you sell an investment property, like I said, you might have a large capital gain. So there's a couple ways. You can do a 1031 exchange to defer that gain. You can also offset that gain with a loss. Okay, so like we talked about, purchase a new property in the same year as your sale. Okay, that would be your gain, and then cost segregate that new property, bonus depreciate it, and offset the gain. Okay, now again, it's still going to be a deferment because now you've depreciated the heck out of property number two, which at some point you're likely going to have to pay back through the recapture of depreciation. Okay. All right. Any questions on bonus depreciation before we move on to our next piece? Bonus depreciation can also be applied during the same sunset time frame. Can also be applied to properties that you buy and hold, not flips, but properties that you buy and hold. Anything that you put into the property. So let's say you buy a rental property that you buy a rental property that you need to put $30,000 or $40,000 into, regardless as to what you do with the so normally if you do, let's say you put in all new windows in a rental property, that's not a dollar for dollar write-off up front. That's a depreciable item. Okay, if you replaced a broken window, that's a dollar for dollar write-off. Okay, but if you replace all your windows, that is now a depreciable expense. Okay, but what we're currently dealing with is if you buy a property and then put $30,000, $40,000 into it to make it livable or upgrade it or update it, you can bonus depreciate the money that you put into that property right up front. Okay, so that's another nice piece there. So that, I think I just answered that question there in the chat. CM, can you apply bonus depreciation to a flip? No, you cannot. If you hold the property, then yes, you can. All of the money that you put up front, you can bonus depreciate that up front, but you have to hold the property. All right. So let's talk about professional. So maybe some of you get my cheat code up at the top here, but I call this method the cheat code. I really think that this is kind of an insane thing when we put this down and you really look at how we have the opportunity to build a tremendous amount of wealth using some of the tax code strategy. Okay, so using real estate as an investment vehicle is, first of all, one of the premier mechanisms for wealth building, right? It is one of the best ways to build a legacy portfolio and build true wealth. If you do it as a real estate professional, it's essentially cheat code. It doesn't work for everyone. Not everybody can do this. Okay, but if you can make it work, or you can do it within your household or with your spouse, this is a really powerful method to build wealth, and I'm going to show you how it works. So first of all, I want to make sure that we have an understanding of what a real estate professional designation is. It doesn't mean you're a realtor. It doesn't mean you're a broker. Doesn't mean you're a property manager. Okay, it means the following. Okay, you have to qualify as a real estate professional, you have to perform more than 50% of services in real property trades or businesses. This is called the 50% test. Okay, so it basically says, and part of this is the IRS is going to look at where you make your money. Let's say you're a CPA and you claim to be a real estate professional. Well, you better spend more than 50% of your time, generally meaning you probably make more than 50% of your income in real estate. Okay, so if you've got this nice cush job, where you're making $150,000 a year, and then you go, well, I'm just going to be a real estate professional and offset my income, probably not. The IRS is going to look at that and go, no, you don't perform more than 50% of your services in real property trades or business. Okay, so the second piece is you need to perform more than 750 hours of service in real property trades or businesses per year. Okay, so this is a 750 hours test. Okay, that equates to about 15 hours a week. Okay, so it's not a significant time commitment. but it is, you know, it's generally something where it doesn't allow you to have multiple, you know, a full-time job and then this on top of it and still exceed income. And the IRS is going to kind of see through that. Okay. The third way is you can have material participation in each rental activity. Okay. And what that means is you can be considered a real estate professional for a particular property. Okay. If you don't qualify for number one or two, so if you don't qualify for the 50% test and you don't qualify for the 750 hours test, you can qualify individually on one particular property, like a short-term rental, for example. So if you are a material participant, meaning you manage your own short-term rental property, in this case, you could then consider yourself a real estate professional for that particular property. And I'm going to talk about how that works here in a second. Let me check this question here. If there are two entities, one to flip and one to rent out, can these strategies apply across entities if an S corp with pass-through taxation? I'm not quite sure I understand your question. Let me get through this, and then at the end we can come back to that. Maybe you can come off and we can talk through it. So let me come back to that. All right, so real estate professional designation, okay? How does this benefit me? Okay, well, there's a couple ways. First of all, real estate professionals are exempt from net investment income tax. So there's something in real estate when you, or not in necessarily even in real estate, but in investing, that when you sell an investment, okay, if you as a married couple make over $250,000 per year when there's money made on an investment, for your real estate investments. So it could be land, it could be, you know, sale of a property management, whatever. There's a 3.8% tax that is assessed to the average individual. Okay, in this case, as a real estate professional, it's zero. So passive income, when you are a real estate professional, is converted to active income. Okay, so in general, when we're looking at how the IRS looks at the income from your investments, let's again take the CPA example. If you are a CPA and you prepare taxes for people or you do financial planning, you earn active income or earned income, and you're taxed on that at a certain rate through the IRS. If you had real estate investments, or if you have, for example, stock investments, that is called passive income. And those two buckets cannot be combined or crossed. So you cannot take a real estate loss, for example, and you cannot use it to offset your income unless you are a real estate professional. Because if you're a real estate professional, the way that you make money is by dabbling in real estate. So that is your income, it's your active income. So what that means is if your passive income becomes active income, then your passive losses become active losses. So what happens is we start to achieve those losses through depreciation and cost segregation, okay? And those losses can be used to offset active income, okay? So if you can see into the future what we're about to talk about, you'll see why this is really, really powerful. So if you file taxes jointly, okay, if one of the people on your tax return can claim to be a real estate professional, they can then acquire real estate, they can take losses, okay, and they can convert all what would used to normally be passive income and passive losses, all that gets converted to active. Okay, and so they can use the depreciation, the cost seg, the bonus depreciation, and they should have a huge loss from that. And then what they can do is we can take those losses and we can use that to offset the active income of the spouse, and we eliminate their tax liability on that person's personal earned income. Okay, so for example, a $200,000 loss, which we just talked about, we did that on one house with cost segregation and depreciation. You could offset the first 200,000 in active income from the spouse, which would amount to $50,000 or more in tax savings. So then what do? Is you take that $50,000 and you turn around and you buy more real estate with it, which then gets cost segregated. And Jeffrey, I'll answer that at the end. So it takes takes that $50,000, and now again, keep in mind that $50,000 is going to have to be paid back at some point because it's not a tax exemption, it's a tax deferment. So, maybe don't do what this picture, insinuates by, going on vacation. Maybe take it and reinvest in real estate. So I want to give you an example of how this is done at a really high level. Okay, we see this, and I teach this method to really high income earners. So I work with a lot of really high income people, and the method that we teach is that if you can get, especially if you've got a huge disparity between spouses. So let's say you've got one spouse that makes $1 million a year, and you've got another spouse that makes 100 grand per year. Well, the first piece to understand there is that the person who makes $1 million a year, their tax liability is significantly bigger than the entirety of the income that spouse number two makes, right? So on $1 million, your tax liability is probably north of $300,000 to $350,000 a year. So that $100,000 a year earner, okay, their earnings don't even touch the tax liability. And so what I teach these people to do is take that $1 million a year and start investing heavily in real estate. And when they invest heavily enough in real estate and they have enough properties to where the spouse number two could legitimately quit their job and claim to be a real estate professional by the amount of management that it takes to manage the portfolio, they can now become a real estate professional. Okay, and now they can cost segregate, bonus depreciate all of the property that they've picked up. Okay, and if they can then depreciate and take a $500,000, $600,000 loss each year, well, now we can offset 50% of the tax liability of the $1 million income earner, thus taking back about $150,000 to $200,000 in taxes. And then we take that $200,000 in taxes and we go do 20% down on $1 million worth of real estate. We take that $1 million worth of real estate, we cost segregate it, we depreciate it, and we take another $200,000 to $300,000 loss the next year, and we continue to compound those losses and continue to offset the high level of income and taxes that are owed by the high earner, and we take those savings and continue to invest in real estate. Okay, so it's a really powerful method that allows you to just defer the tax liability that you would normally have. So if you could defer $100,000 worth of taxes over the next, let's say per year, over the next 10 years, in 10 years, or actually as long as you want, let's say you did that every year for 10 years, and then after that you stopped acquiring, and then 30 years from now you sold all the property. Well, in 30 years, that you would have purchased $10 million worth of real estate, but in 30 years, that real estate's going to be worth 20, 30, $40 million, and you still only own the government $1 million, $100,000 a year for 10 years. There's no interest on it. There's no penalties on it. So you go to sell all that real estate 20, 30 years from now, it's worth 20, $30 million, but you only owe the government $1 million. You just borrowed $1 million from them tax-free to invest in $20 million worth of real estate. Okay, so it's a really powerful thing that exacerbates the gains that you have as a real estate investor. It's really significant. Okay, so that's the strategy that we teach to people, especially couples, and that is it's a tremendous opportunity to again get one person out of working. And to minimize and even sometimes just completely delete the tax liability that the high income earner has. Okay. All right. Questions on real estate professional status, and I'll come back to some of the questions in the chat. So to reiterate, like I said, this isn't necessarily for everyone, right? That not all couples have the ability to go, oh yeah, well, one of us is going to quit our job and become a real estate professional. Sure, but my point is, over the next 5, 10, 15, 20 years, it might be something that you could work towards if you start acquiring property every couple of years or every year or however, your income level allows you to do it by and you don't have to save a ton of money to do that. You can take my intermediate class and I'll show you how to scale your properties to leverage one property to the next. And then you can have an opportunity where maybe the spouse comes along and you go, we've got all this property and you don't really need to work anymore, so I'll continue to work and you can manage all these properties. And now you become a real estate professional after many years of acquiring, and then offset your taxes, moving forward. So there's lots of different opportunities to do this. You can cost segregate and you can bonus depreciate a property at any time. So if you've owned a property for 5 or 10 years, you can go back and you can still do a cost segregation and you can still implement it and take the losses on it now. Ed, to answer your question from earlier in the conversation, the reason you wouldn't do this is if you had enough write-offs through A, straight line depreciation, B, the mortgage maybe that you've got on the property, the taxes, the insurance, that type of stuff. If you've got enough write-offs to fully offset the income that's coming in the property so that you're at least neutral, at least you don't have a positive income on paper, then if you're not a real estate professional, there's not a huge necessity to do it, unless you needed to offset a future a sale or a purchase, right? So let's say you sell a property and you're like, man, I'd love to offset that gain. Well, buy another property and then cost segregate it and do that. And so some people will do that in order to avoid doing a 1031 exchange. So the 1031 exchange puts some parameters around your purchase. The first thing is that when you sell your first property, you only have 45 days to identify a new property. And so depending on how that works, if you can't find a place, like it's tough. And so now you're going to owe all the taxes on that first property. So if you want to figure out a way before the year ends to not owe the taxes on the capital gain of that first property you had, well, then I think it's really important to know that you could buy another property, cost segregate it, push all of the losses up front, and then push a loss against that first property. And it's very similar to doing a 1031 exchange in that we're just now taking that capital gain, we're getting a tax. It's essentially an exemption now on the first property, but now we've taken a bigger loss on the second property that at some point we're going to have to pay back. So it's similar to deferring it, but our first property is now completely off the hook. We just accelerated the amount of losses we took on the second property. Does that make sense? You can find your unmute button. Cool. All right. Let's see here. What other questions do we had? CM, do you want to come off of mute and let's walk through your question that you had there?
Hi, can you hear me okay?
Yes, I can.
Okay, great. So the question was two different strategies. One is a hold and the other one's a flip. We set up two different entities for both, but we're also set up as S corp with pass-through taxation. So if we have a flip going right now, once we sell, if we cannot get something in time to fulfill that 1031, but we were able to buy something a little bit later for the rental, want to be able to maybe, I don't know if I can use a 1031 for a rental, knowing that they're two separate entities. I hope that makes sense.
So one, you cannot 1031 a flip. I don't know if that was part of the question, but you have to have owned the property for at least a year to do a 1031 exchange. So that's first of all. The second piece is it is somewhat difficult to do a 1031 exchange from one entity to another, but if you can show that the entities are both owned by the same person or the same people, you could probably do it. And so, like, if you bought a property with one entity and then wanted to 1031 that property and use that money to purchase a property in the other entity using a 1031, you could probably do that as long as you can prove that, again, both entities are owned by the same person. The other thing could be you could always just do the 1031 from one entity to the other, and then you could quit claim the property into the second entity. So there's ways you could do that. Does that make sense? Did I answer your question?
Yep, you did. Spot on. Thank you.
Okay, perfect. Yeah. So I imagine the only way I could think that would be something you would do would be is if you were 1031ing if you had an investment property that you wanted to sell and then use the proceeds to buy a flip. Is that the kind of the intent?
Yeah, that's the goal and the thought. But there's also some other things that we know we got to work through, right? So being able to, what's the word I'm looking for? Make sure that like we give ourselves a paycheck, right? So just those little things we want to make sure that we're working through. But essentially, we want to be able to use that cash or that equity to purchase else
Yeah.
for a rental.
Yeah, and so just know that you can't exchange a flip into a rental. That's the difference there. So, but again, you because the problem is with flips are short-term capital gains, and short-term capital gains are taxed like regular income, and so they're taxed at whatever your earned income level is. But again, that's where you could then buy a property and cost segregate it, and then you could offset gains that you made by selling a flip. And that I think there's a lot of value there.
Thank you. That's helpful. Appreciate it.
Yeah, you're welcome. And do you mind me asking where you're out of?
We're out of New York.
You said New York?
Yes.
Cool. Yeah. So, and again, confirm with your CPA. My full disclosure, by the way, here is that I am not a CPA and I'm not a tax attorney, but I'm fairly well versed in the real estate world of things. And so, consult your tax attorney or consult your CPA about this type of stuff. And if they're not familiar with cost seg and 1031s and bonus depreciation and stuff like that, find a new CPA. Cool. All right. Let's see. We had another question here. Jeff asked, this is not on the topic, but asked if I'm part of the National Association of Realtors. Yes, I am, and also part of the local boards. How important is it, Jeffrey, is your question, how important is it that I'm a member of that, or how important is the association itself?
It's all good. I just wanted to know.
Sure, no problem. Let's see here. I think that's it. I will send I'll get the recording up, and I'm happy to send it out to you guys. A little bit of information about ourselves. This is our team. You can take down any of our info there. Contact us, yeah, if you get further questions, I'm happy to help. We work in kind of, like I said, all realms of real estate. We help with flipping and overall portfolio building and acquisition. I do multifamily. So we're very well versed in those things. So if there's anything that we can do to help, please let us know. I run these webinars every month. They're usually on Wednesdays, and all of it is on Eventbrite and on Meetup. So if you got anybody that's interested in learning it, please have them hop on. My intermediate class, Jeff, is, let me see here. Oh, if you pop on any of these, like if you hop on this QR code here on Meetup, it'll tell you when it is. I can't remember. Let me see if I can see what next month is. It's either next month. I rotate through them, so it's either next month or the month after that.
Okay, yeah, I'll figure it out.
Yep. So I apologize. I don't have that, but it's the intermediate's and the intermediate one is my favorite one to teach, and I think it's the most relevant for most individuals. Like I said, this is a really high level tax kind of strategy class, but it requires some. You got to have some ability to be able to become, for example, a real estate professional. And so the intermediate class really teaches how to scale, and I think that one's my best class. So anyway, take it if you want to take a QR code of any of these. You can also look us up on YouTube. I think all of my classes are on there as well. So if you want to come to a live class, please do. Otherwise, all of our classes are on YouTube. So one of my prior presentations of this class is probably already on YouTube. So anyway, check that out. I also have a podcast with about 40 episodes on it that talks all about real estate investing, and it's everywhere from your first acquiring your first property all the way to like stuff like this and acquiring multifamily and doing syndication and stuff like that. So if you have an opportunity, if you just if you
So I got his
would
name and his contact info. Oh,
shoot
sorry.
Oh, you're good. Shoot that QR code and if you've got any feedback on the presentation, I'd appreciate it. If there's anything that I didn't explain well, it helps me moving forward. So I'll hang on the call here for another 5 minutes or so. If anybody wants to hang out and ask any individual questions, I'm happy to answer them for you, happy to help. And anyway, thank you guys for being a part of it tonight and spending your Wednesday evening with me, and hope you guys have a great rest of your week and weekend. Let me know how we can help. Thanks, everybody.
I just wanted to say thanks, Nick. And also, this was a lot of information for me. I just literally just got interested in real estate investing.
Yep.
But the way, even though the topics you were talking about are really complicated, I feel like I really got a grasp of a lot of stuff. And I'm looking forward to that intermediate class. I just want to say
Awesome.
thank you. Appreciate
Yeah,
it.
thanks, man. Yeah, come to the intro and the intermediate class. They're both really good. And you said you're in the Springs, right?
Yeah, and actually, I had another question. Do you guys have you ever worked with like a VA loan? I was planning on using my VA loan to get me started in real estate investing.
Yeah, there's some cool stuff you could do with a VA loan too. You can buy your first property with a VA, get a little bit of equity in it, and then refinance it into a conventional loan, and then you get your VA loan back, and then you can go do it again, and you can literally cycle that VA loan over and over and over again to basically buy property with no money down ever.
Oh, damn, thank you.
Yeah, so the VA loan stuff, it takes a little bit of patience because you gotta wait for the market to do its thing and get a little bit of appreciation so that you can refinance it into a conventional loan. But that's the nice thing about a VA loan is there's no money out of pocket. You literally don't have to have anything for a down payment, and so you can go out and buy a house for literally no money down, wait 3 years till it's got 5, 6, 10, however many, whatever the market does, call it 10% equity, refinance it into a conventional. Now you get your VA eligibility back. Then you go out, buy a new property with your VA loan, and you rent the one that's now got a conventional loan on it. Okay. And then 3 years later, you do the same thing, and you just keep cycling that VA loan through, and you literally can just continue to buy property over and over and over again with no money out of pocket ever. And so it's kind of the ultimate kind of what we call the infinite money glitch, or the infinite money return, meaning that like you're making a return on all these properties that you have. So through appreciation, through you may or may not have cash flow, because if you're buying properties for no money down, that the mortgage is going to be pretty high. So when you go to rent them, it's hard to be cash flow neutral, at least in Colorado. So you might be a little bit cash flow negative, but you get appreciation, you get principal pay down, and you get maybe a little bit of cash flow of the property. That overall, depending on the amount of money invested, is gonna create a percentage return. generally speaking, in Colorado, we see those returns with for investors that they're doing 20 to 25% down. Real estate returns with those three things generally end up being somewhere in the 22 to 30% range annualized. People that are house hacking, those returns double and triple. And then the thing is so they might see a 50 to 60 or 70% return annually. But if you're using a VA loan and you've got no money into the property, it's technically an infinite return, because any money you make on a $0 investment is an infinite return. And so it's called the infinite return hack, or the infinite money hack, and it's that your investment is zero. People without VA loans do it by what they call the BRRRR method. And so the BRRRR method is the buy, renovate, rent, refinance, and repeat. And so those people go in and they buy a property, they renovate it, they rent it, and then they refinance. And if they can refinance all the money out that they put into the property and get all their money back, they now own the property for no money down, and anything that they make on it is an infinite return. Does that make sense?
That makes perfect sense. Thank you.
So you can do that with a VA loan. Just takes a little bit of time and patience, but over 10, 15 years, like you can buy 3, 4, 5 properties, single family properties, for no money down and have a handful of rentals.
Okay, thank you. I really appreciate that.
Yeah, you bet, man. Keep me in mind if you need anything. Happy to help. Keep my info available.
I definitely will. I'll be rewatching this recording about the other stuff you talked about. Thank you.
Awesome. Anybody else have any other questions? All right. Well, thanks again, everybody. Appreciate you. And I'm taking down you guys' emails so I can send you.
A good book to read?
Yeah.
Quick question for you.
Yes, sir.
What would be a good book to read?
What in particular?
Just real estate? Any specific to know?
Yeah, so I don't do. Sorry, I'm copying everything down. I don't do a ton of books. Most of my stuff I get from podcasts, but there's a couple of books out there. One's written by Brandon Turner. One's written by David Green. Let me take a look and see. Brandon Turner's the guy that originally did Bigger Pockets. So, and David Green now owns Bigger Pockets, and those guys do real estate at a very high level. And I know they both have books out. I can't remember their titles. I can see if I can find them here. But they also, David Green also runs the podcast on real estate investing and on Bigger Pockets. But that's probably one of the most popular websites for this type of stuff. And so. Let me see what their book is.
You mean David Green, the one that wrote the 48 Laws of Power?
I can't remember if that's his book title or not, but he's the guy that hosts the Bigger Pockets podcast.
Oh, okay.
So let's see. Brandon Turner has a couple of books. He says the book one is called The Book on Rental Property Investing. He's got one that's The Multifamily Millionaire. That's syndication though. So which is a whole different thing. Syndication is if you want to buy like apartment buildings with a bunch of people. So if that doesn't interest you, don't worry about The Multifamily Millionaire. If it does, then you could do that. He also wrote one called Investing in Real Estate with No Money Down. That one is similar to the syndication deal, but the book on rental property investing, I think, is a good one. And then he's got another book on the BRRRR method, which is the buy, rehab, rent, refinance, repeat. And then let me see, David Green. He wrote Long Distance Real Estate Investing, which is if you wanted to invest outside of like your local market. And then he also wrote a book on the BRRRR method as well. So I think he also wrote a book called Scale. And but he's got a handful of stuff. So David Green is his last name is Greene, and so you could look him up. Just Google him, David Green books, and then the other one is Brandon Turner. And then yeah, Devin, you're right. You could that's always a good book. Rich Dad Poor Dad, Robert Kiyosaki. It's always a great investing book. And listen to kind of Robert Kiyosaki. He's all about taking on good debt. So just depending on what type of investing you're looking for, you can go the Dave Ramsey method and not have any debt at all, or you can go the Robert Kiyosaki method and have all debt. So, or somewhere in between. All right, anything else?
No, thank you. Thanks for your time. Appreciate it.
Absolutely. Thanks, guys. Appreciate you all, and hope to see you on the next one.